Hi there, welcome to Kneppy Invest. In today's technical update, 5th of March 2023 edition, I'll be focusing on 11 ASX companies with the company of the day being Domino's Pizza. This company released their half-year results a few weeks ago now, and on the day the share price fell something like 25%. I did a standalone video on Domino's Pizza on that day because it was a significant negative reaction from the market, and the share price has kept on falling. In fact, the share price now is below $50. And a few months ago, I think it was about November, December last year, when I did some research on this company, I thought if the share price went below $50, that would be a good time, a good price, a good valuation to take a position in this company. So whether I take a position in Domino's Pizza remains to be seen right now, just because of the amount of negative sentiment in the company. But the share price is at really interesting levels. There's a few reasons why I picked $50 valuation, and then when I look back at the long-term chart for Domino's Pizza, around about $45 to $50 was a really interesting range, and you'll see that when we look at the longer-term chart. The other 10 companies I'll be looking at in today's video include, now technically I won't be giving a technical update to Slater and Gordon, it's just a business update to that company because I did feature that company in last week's technical update. But when I did see they release the half-year results, share price went up 6% on that day. I thought it was just based off the half-year results. But they also released another announcement, which was a really intriguing, interesting announcement. The sort of announcement you see a lot, but there was something really unique about the announcement. And that will become obvious when I give a bit of an update to Slater and Gordon, the business update, not a technical update. But all the other companies I'll be focusing or featuring in today's video will be a technical update. And those companies are Qube. I have never had a look at this company before, but technical-wise, it is looking interesting. Aussie Broadband, share price looks like it might be breaking out after they release half-year results. I'll talk about their half-year results, and they also released a profit upgrade, which is the most powerful type of announcement a company can release. Dusk has a special place in my heart. Talk about that when we look at Dusk's chart. And then the next four companies we'll be looking at include Downer, complete opposite to Aussie Broadband. They release a profit downgrade, and as you would expect, the share price took a massive hit. On the opposite side of the spectrum of Downer, Duratec released half results, and the share price has taken off. I think it increased something like 25% in the week. Absolutely spectacular results, and the share price, or the chart, looks absolutely spectacular as well. Gentrack, a company I do own, I took profits a few months ago because the share price took off after some good announcements from the company, and then I thought I'll be smart. I was thinking maybe the share price would pull back. I'll take profits and then add to my position if the share price pulled back. The share price never pulled back. And then Envirosuite, a company I do follow quite closely simply because of what they do. I'm interested in that company on a really professional level, but the company's not profitable, not operating cash flow positive, free cash flow positive, but chart or technical wise, it is looking interesting for that company, and not the good sort of interesting, the negative sort of interesting. And the last two companies I'll be looking at in today's video are DGL, and I did have a very short-term position in that company, and then the CEO did something silly. Share price pulled back a lot, but that company is starting to look a little bit more interesting as well, alongside the release of their half-year results and a possible technical breakout in the share price. And then the last company is QBE, and I'll be looking at the long-term chart. And when I say long-term chart, a monthly chart for QBE over the last, I think it's 30 or 40 years, and it is actually looking really interesting when you look at that really long term for that company. The company of the week is Domino's Pizza. In fact, probably the company of the last 2 weeks is Domino's Pizza because the share price has absolutely fallen significantly over that period of time since they released the half-year results. So just before they released their results, the share price was around about $71. Share price now is below $50. So share price and the valuation of this company has taken a massive hit, and the share price has fallen below the lows we saw back in October of last year. Now, I've always known about Domino's Pizza. I'm not the biggest fan of Domino's Pizza. In fact, when I did some research on this company between about November and January, the last bit of research I did was go to a Domino's store and get some pizzas. and I was disappointed, but I knew I was going to be disappointed because every single time I try Domino's pizzas, I am disappointed, maybe once every 3 years. But of what I remember, they were smaller and they were more expensive. So I was highly disappointed. But that's not a real reason to either not take a position in the company or take a position, because I don't think I am the market that they are aiming towards, because I do prefer premium pizzas. And really, Domino's Pizza don't have any premium pizzas. I think they might call some of their pizzas premium, but I would not classify their pizzas as premium. So I was a little bit turned off by the pizzas, but that should not be a deterrent. But I was mostly deterred by the share price. It had rallied quite nicely from the lows of $50 to about $75, $76. So that's a nice 50% increase in the share price in a short period of time. It did look like the share price was trying to move into an uptrend, but I thought I'll just wait to the half-year results just to see how the company was performing. And of course, they released half-year results. It really disappointed the market. Share price has absolutely fallen off the cliff. But where the share price is right now is really interesting. So I was thinking during my research, at a share price anywhere below $60, I would be a little bit more intrigued in taking a position. But if the share price fell below $50, I'd become really intrigued. And that's where the share price is right now, below $50. And there's a couple of reasons I picked below $50. One of the reasons is just based off valuation and the potential of really good growth over the next decade. But the other reason is around the lows during the COVID-19 financial panic. And the low, well, not the lows, but the weekly low closes, if that makes sense. So the lowest we saw in the weekly closes was around about $47 or just below $48. And that's that horizontal dashed line. And the share price right now is just above that. So the way to look at Domino's Pizza right now is the amount of negative sentiment is sort of comparable to the negative sentiment we saw in this company back during the COVID-19 financial panic. So let's have a look at the longer term chart just to see where the share price is right now compared to about the 3 to 4 year picture. And it's been a really interesting ride for Domino's Pizza. Share price reached a high of $168 or just shy of $168 back in September 2021. And of course, a share price of $168, which would mean the valuation of this company got to ridiculous heights. And that was, Domino's Pizza was a real beneficiary of COVID-19 and lockdowns. Every man and their dog was buying pizzas. Maybe not from Domino's Pizza, but they were buying pizza from other places, buying takeaway food, being delivered to the house, that sort of thing. And a lot of investors thought that those good times were going to continue forever. And the reason I say that is because the share price just kept on increasing to ridiculous heights. And then the sentiment suddenly shifted in September, October 2021, and the share price fell significantly from $168 all the way down to $50. So that's a significant 70 to 75% decrease in the share price. But if we compare the share price right now to the share price we have seen over the past 3 or 4 years, during the COVID-19 financial panic, we did see the share price get to between about $45 and $50 for a few weeks before we saw a really good bounce. And then if we go previous to that, the last time the share price was this low was way back in the middle of 2019. So if you are looking at the longer term picture, you could see and argue there is value in this company right now, particularly because of their plans for the next decade. And that's why I am interested about taking a possible position in this company for the long term. But I think just with the negative sentiment, there is potential the share price could fall further from here. Now onto the extraordinary events, happenings of Slater and Gordon lawyers. And I don't really follow this company at all. And it wasn't until on the 3rd of March at 2:24 p.m. when the company released an announcement called or titled Allegro Bidders Statement. And when I saw that announcement, I went, is someone trying to take over Slater and Gordon? And yes, someone is trying to take over Slater and Gordon. And if we go back to the 22nd of February, so I've got all the announcements the company has released since then, Slater and Gordon went through a trading halt on that day in relation to a material transaction or something like that. And then on the 24th of February, they released 4 announcements. 3 of those announcements had to do with the half-year results. So the half-year accounts and reporting accounts, half-year financial results and business update, investor presentation slides, 3 announcements you typically see from big companies on the ASX. But the other announcement was bid implementation agreement with Allegro. So this company called Allegro PE company, private equity, I don't know. I don't really follow this company at all, or Allegro. They want to take over Slater and Gordon. So I thought at that point in time, without even opening up the announcement, I thought the reason why the share price increased 6% on that day, the 24th of February, was because the takeover bid for Slater and Gordon must be like 63, 64 cents. So typically when a company does make a takeover bid for another company, the share price won't get up to that level. It'll just be shy of that level because of risks involved. But then I opened up the takeover offer from Allegro, and this is what it said. Allegro to make a 55 cents a share takeover or cash off market takeover offer for 100% of the ordinary shares in Slater and Gordon, which was a really interesting price because before Slater and Gordon went into a trading halt on the 22nd of February, the share price was 56.5 cents. So this takeover bid by Allegro for Slater and Gordon is a discount to the share price. I have never seen this happen before on the ASX. Typically, when a company makes a takeover bid for another company, it has to be at a premium, a 20% premium, a 30% premium, a 40% premium. Because why would shareholders accept a discount to the current share price? And even more extraordinary, the management of Slater and Gordon said to the shareholders, you should accept this discount. And some of the arguments were absolutely ridiculous from Allegro and from the management of the company. In fact, I might do a standalone video because this is a really extraordinary set of circumstances for Slater and Gordon. If I was a small shareholder of Slater and Gordon right now, I'd be absolutely furious that the management have accepted this takeover bid from Allegro. But I sort of can understand it because I'm assuming because of the problems this company has gone through over the past, say, 4 or 5 years, there are some shareholders on the books of this company who are fairly large shareholders who just want to get out, take their money and run, and 55 cents a share is good enough because the shares in this company are quite liquidly traded and they probably can't get out. So they are looking for a way out. 55 cents a share is a good price for them. So they want this bid to be accepted by management. They've told management this, and this is why management have said, shareholders, you should accept this takeover bid, even though it is a discount to the current share price. I'm not sure why the share price rallied 6% on the 24th of February to 60 cents, because the share price has pulled back to 55 cents. I think the market was getting a little bit excited that 55 cents was too low. Obviously, there has to be a better bid come in later. Obviously, 55 cents is a discount. So really interesting occurrence at Slater and Gordon. I have never seen this before. If you have seen this happen before on the ASX or maybe on another equity market around the world, I'd love to hear about it because a takeover bid at a discount to current share price is absolutely ridiculous and absurd. Now back to looking at charts. And the first chart we're going to look at is Qube. I don't know much about this company. It says porks and bulk on here, so probably logistics, transport logistics, something like that. I am tempted to take a closer look at this company just based off the chart. So the chart is looking interesting. The share price was in this downtrend, and I portrayed that downtrend by this sloping dashed line. And every time the share price hit that downtrend, we saw the share price pull back. And that's a sign of a strong downtrend. In fact, it hit that downtrend 1, 2, 3, 4, 5 times. And then on the 6th time, it looked like maybe you'll see the share price pull back was in late November, early December of last year. But instead of share price pulling back, the share price kept on rising. So the share price has broken out of that downtrend, is now in a burgeoning uptrend, which makes the company look a little bit more interesting for me, particularly because I have no idea what this company does. So I did take a little bit of a closer look to Qube, not around the business itself, but just some of their financial metrics. And what I've seen over the last 15 years is a massive share dilution. So the shares on issue have gone from 200 million 15 years ago to 1.7 billion. I don't like to see that sort of share dilution over a long period of time. I do like to see companies who have their shares on issue fairly steady over like a 10 to 15 year period. Most companies, you'll see a steady increase in shares on issue, but not like that's an 8-fold increase in shares on issue over a 15-year period. Mediocre 10-year revenue growth, 0.3% over the last 10 years. But I did mention here in my notes, accelerating in the last year to 33%. So that's possibly why the market is getting a little bit excited because of this accelerating revenue growth. But that's just 1 year revenue growth of 33%. But the revenue growth has also been helped by a share buyback from the company. So even though there has been massive share dilution over the past 15 years, the company has now gone to the point where they're decreasing the shares on issue, which is actually a good thing in the long term, particularly if the shares or the company is undervalued, and I'm unsure about that right now. Another thing I looked at is return on equity, return on invested capital. It has been quite low over the last 10 to 15 years, around about between 2 and 5, which is telling me the potential for significant growth for this company is quite low. So another reason to be a little bit skeptical about the share price run, unless there's really good value in this company at current share prices. So the only reason at this point in time, without doing further research on the company, I would take a position in Qube is just because the share price has moved into a nice looking uptrend. Now onto Aussie Broadband, and I've been holder of Aussie Broadband a few times since they listed, and I decided to take a position in this company and just hold it for the long term because I do think there is potential for significant growth in this company. Every single time I talk to an Aussie Broadband customer, they love the customer service. I don't care about customer service because I very rarely call up or need customer service. In fact, in my old provider, TPG, I was a customer of them for about 14 years. I never called customer service, but everyone raves about customer service for Aussie Broadband. That's their competitive advantage over their competition, and it seems to be working for the company. Now, you might say, well, between about May and say October, November of last year, it wasn't working because the share price went from about $6.50 all the way down to less than $2. But I think that was just the market overreacting. Share price now is moving into an uptrend, and on the back of their half-year results, and the half-year results were really good. Not only were the half-year results good, they also issued a profit upgrade. The share price has taken off, and the share price right now is at a 6-month high. Last time the share price was this high at $3.37 was way back in August last year, which might not seem that far along or that far ago, but 6 months for some people is a long time. Now, if you have a look at the half-year results, revenue up 27%, EBITDA up 86%, gross margins up 35%, but up 2.5% to 35%. Operating cash flow up 35% to 30.8 million. Total broadband up 27%. So this company is growing, but more importantly, the company also issued a profit upgrade, and that's why the share price has taken off. I think share price is up about 20% during the week, after the share price was down on the Monday when they released the half-year results because the overall market was quite negative on that day. So looking way more bullish for Aussie Broadband. In fact, the last time I was looking this bullish was about 1 or 2 years ago. Now onto Dusk. This does have a special place in my heart because back just after they listed on the ASX in December 2020, the company did release a profit upgrade. And the back of that profit upgrade, I did take a position in the company, even though share price rose 18% on the day. Then the share price doubled in a short period of time. And then I took my profits, and that was a great trade for me because the share price has now pulled back to the levels, or actually below the levels I initially took a position in this company. But you could argue that Dusk is really undervalued at current levels. But the market is thinking there's going to be but there's going to be tough times ahead for Dusk, that they will see revenue drop because people will spend less in their stores. Now, I have never gone into a Dusk store. I have never bought candles, that sort of thing. But again, I am not the market that Dusk is aiming for. But when you do look at some of their numbers, it is interesting. Now, half-year numbers, revenue was up 7%, but like-for-like store sales was down 10.4%. So they have opened up more stores, which is why overall revenue is up. Net cash of 33 million, market cap of 106 million, which means the enterprise value is quite low. EBIT of 19.1 million, which means that EV to EBIT, which I think is Tobias Carlyle's favorite metric, is around 3, which is screaming potentially really, really cheap. Return on invested capital 24. I might think that would fall over the next year, but that's a really good number for return on invested capital. Gross margins of 66%, not quite as good as Lovisa, but those are sort of the gross margins I would be looking at for a retail company. P ratio 6.5, which is on the trailing 12 months earnings. So the market obviously is expecting earnings to drop from here. If earnings don't drop from here, this company is awfully cheap at current levels. Now onto the chart. Now, one of the reasons I've included Dusk in this video is just where the share price is right now, just above a really important support level at about $1.62. We saw the share price reach that level back in June. Remember, June was really bad for the overall market. A lot of companies' share price low in the past year was in June of last year. That was true for Dusk. But Dusk keeps trying to get back to that level, and every single time the share price gets below about $1.75, we do see a rally in the share price. And right now, the share price is at $1.69. The other thing that is quite noticeable about this is every single time the share price rebounds after these lows, the share price, the next high, is lower than the previous high. So this is looking like a descending triangle, which is a bearish signal. So I wouldn't be surprised to see that horizontal dash line, which is a support level, be broken in the future. But just based off valuation, this company is looking interesting. This is the weekly chart for Downer, going all the way back to the middle of 2019, so pre-COVID. And pre-COVID, the share price of Downer reached a high of $8.80. And then the share price was absolutely hammered during that COVID-19 financial panic, falling from $8.80 to $2.60. And of course, we saw the V-shaped recovery in the share price. If the share price went from $2.60 back up to $6.80, which was reached in September 2021. But since those highs in September 2021, share price has been dropping, and the share price has been punished twice in the past 3 months because of negative announcements from the company. But the share price is falling towards those lows we saw back during the COVID-19 financial panic. So only about, we'll say about 60 cents higher. And there is potential, because there is a saying, profit downgrades comes in threes. Sometimes it comes in fours. Sometimes it comes in fives. Sometimes it comes in ones and twos. But profit downgrades do come quite closely compacted together. And we have seen two for this company in a 3-month period. So there is a potential, not a certainty, just potential that this company might release another profit downgrade in the next few months. And if that does happen, that $2.60 support level, those lows we saw back in the COVID-19 financial panic, that support level might be broken. But just based off a technical reason, $2.60 does look interesting for this company, just for a technical trade. On the flip side to Downer, we have Duratec. In fact, this is the sort of chart you want to see if you are a shareholder of a company. And I might be a little bit biased because I am a shareholder of Duratec. And the main reason I took a position in this company is just because of the chart. Then I had a closer look at the business. And I wouldn't necessarily call Duratec a high quality company. And I'm more willing to hold a high quality company for the longer term. But some of the financial numbers coming out from this company do look interesting and promising. I'll talk about that in a second. But if we go back to the chart, this is the daily chart going back to February 2022. So during most of 2022, share price of this company was going sideways. It was consolidating, and that was after a period the share price was in a downtrend. So after the share price comes out of a downtrend, you want to see a consolidation period. And that's what we saw for this company. And then you wait for a breakout in the share price. And the breakout of the share price happened in November. And then the share price started to move up in a well-defined, beautiful-looking uptrend. And it has just continued. In fact, the share price has more than doubled since November last year. So over like a 3 to 4 month period. And then the company released the half-year results on the 28th of February, which is the last day, the Tuesday. Some people say you only see bad results released on the last day of the results month. That's not necessarily true, and Duratec proved that. They released their results on the last day they could, and the results were really good. Share price rallied 25% after they released the half-year results. So just by the market reaction, we know the results were good. But just look at some of the numbers, some of the increase in their metrics. Revenue up 75%. Now, some of these increases are because of some acquisitions, but revenue up 75%, profit up 981%. You could argue that's on a low base, but still up 981%. Cash up 67%, and they also doubled their interim dividend. So this is a dividend-paying company. Now, I'm unsure about the future of this company because I wouldn't quite qualify Duratec as a high quality company. They haven't been long on the ASX, so a recent IPO. So I probably need to see a little bit more history before I consider this company high quality. And I'm more likely to hold a high quality company for the longer term. But things are looking promising for Duratec right now. Now to Gentrack, and I am a long-term shareholder of this company. And originally I bought into Gentrack because I thought the market overreacted because the market pessimism around this company drove the share price down from $8 all the way down to a low of less than $1 at one point in time. So I took a position in this company because I thought the market overreacted, took a position about $1.10, and that was a few years ago. And the share price just went sideways. We saw little rallies in the share price, but eventually my patience paid off in November last year when the share price went from $1.50 to $2.30 in 2 trading days on the back of some good news from that company. And after that rally in the share price, I thought I should take some profits. I don't want to sell out all my shares in the company because there is potential the share price could increase from here. But I also thought there was the potential that there will be some profit taking because of the rapid rise in the share price, and the share price could pull back. And if the share price pulled back below $2, I would then buy back some shares. But the share price never pulled back. And that's telling me there was some strength in that initial rally from $1.50 to $2.30. If the share price has kept on rising, and share price right now is at $2.78. If you see the share price pull back significantly on large volume after a rally in the share price, like you saw in Gentrack, that is showing you that that initial rally was not strong. There was a bit of weakness there. So it's good to see when you see a really big increase in share price just goes sideways for a little period of time, like you see in Gentrack shares, and then the share price starts creeping upwards, like you see in Gentrack's chart. So even though I did take profits, and that was a mistake in terms of share price has kept on increasing, I don't think it was a bad decision. Taking profits is okay, but sometimes you just want to ride your winners. So I sort of hedged my bets here. I took some profits, but maintained a position in this company just in case the share price kept on increasing. Now on to Envirosuite. I've never had a position in this company. I think I might have had a position in Envirosuite when they were the previous name. I totally forget what their previous name was, but that was many, many years ago. But the main reason I'm interested in this company is on a professional level. What they are doing is intriguing and possibly exciting, but Envirosuite is not profitable. I'm concerned about the lack of significant growth in their business, not profitable, not operating cash flow or free cash flow positive. But what is interesting is on a technical level. So the share price of Envirosuite was in this long-term uptrend. And I've just connected all the lows we have seen over the past, say, 4 years, going all the way back to the start of 2018. And I've portrayed that uptrend by that sloping dashed line. And every single time the Envirosuite share price got to that uptrend, we saw a nice little rally in the share price. Sometimes the market gets a little bit too excited about this company. That's why you see an over-exuberance in the share price rise. We saw that back in August of 2019. Share price went from 12.5 cents to about 37.5 cents in about a 5 to 6 week period, and then the share price pulled back. And that's the problem with these sort of companies. They're not profitable, not generating any cash in their business. You're going to see a lot of volatility in the share price, and that's definitely true for Envirosuite. And the last time we saw the share price reach that uptrend line was back in September, October of last year. Then the rally was very, very weak. Not a lot of volume. Share price went from about 11 cents to about 15, 14 cents. So not a lot of excitement. The share price had reached that long-term uptrend line. And then in the last 2 weeks, the share price of Envirosuite has fallen below the uptrend line. And that is a bearish signal. So there is potential the share price could is now out of the uptrend cycle, and who knows where the share price has to go from here, because yet the management has yet to prove that this company can be viable for the long term, and the market cap of Envirosuite is still above $100 million. So I need to see some proof that this company is or can be profitable, can be operating or free cash flow positive, and the company hasn't showed me just yet. They can achieve that very important inflection point. It has been an amazing rollercoaster ride for DGL shareholders, particularly those shareholders who have been invested in this company since they IPO'd in May 2021. Now, the share price on that first day of trading, I think, was less than $1. And from May 2021 all the way through to April 2022, this company's share price rose from $1 to a high of $4.50. So almost a five-bagger for those shareholders. But there was some problems on the horizon for this company. The CEO did some silly things. I won't talk about those silly things. And then in September, late August last year, the share price fell from $2.80 all the way down to $1.50. Now, that must have been some negative news from the company, but it seems like it was just a short-term hit, because from that time all the way through to just recently, the share price has just been going sideways. So I think the market has seen some value in this company. The company is profitable. The company is growing, and they revealed that and showed the company is still growing when they released the half-year results. So revenue up 52%, profit up 22% to $10.4 million. Now, return on invested capital and return on equity are hovering around 10. I would like to see that a little bit higher, and the company has shown they can have those metrics a little bit higher in the past. But it's interesting just to see the chart. It does look like the momentum in the share price is starting to go from a consolidation period into a possible uptrend. And definitely the sentiment in this company is shifting from highly negative to even positive. And the share price is around about $1.84. The last time the share price was above $1.80 was way back when the share price fell off a cliff in late August of 2022. So we're almost at a 6-month high. Well, maybe we are at a 6-month high right now with DGL. Sometimes I will look at monthly charts, particularly for companies or indices that have been around for a long time. And QBE has been around for a while. And this is a monthly chart for the company since 1994. If you have been a long-term investor, hopefully you bought some QBE shares in 1994 or 1993 when the share price of this company was around about $1, maybe $2. Yeah, about $1. Because if you held for the next 13 years, this would have been a 35-bagger. Yes, a 35-bagger for an insurance company. Share price went from $1 in 1994 to a high of $35 in 2007. Now, maybe you would have sold out your shares back in 2001 because there was 1 month when there was a massive hit to the QBE share price. In fact, the share price went from above $10 to about $3 in 1 month. So obviously there was something happened in 1 month, more than likely maybe a profit downgrade or something negative, but the share price recovered fairly quickly. And that period between 2001 and 2007 would have been an awesome time to have QBE shares. And just look at that sort of an acceleration in the share price increase during 2006 and 2007. That was probably a dead giveaway that the good times were coming to an end. And the share price high for this company was in 2007. The company has struggled since then. Share price has fallen from $35 to a low of about $7 back during the COVID-19 financial panic. However, there has been a really nice rally in QBE shares over the past 6 months. And the share price has risen to about $15. Now, $15 is a resistance level. We saw the share price rise to $15 just prior to COVID-19 and then fall away during that COVID-19 financial panic. And the last time the share price was $15 was way back in 2013. So we're almost at a 10-year high for QBE shares. Not only that, I have heard QBE mentioned in a few podcasts, particularly fund manager podcasts. So there are a few more fund managers becoming interested in QBE. In fact, QBE was the butt of fund manager jokes because of lack of performance in their business. So potentially fund managers are changing their opinion on this company, and that change in opinion is shifting the sentiment in this company. That shift in sentiment is driving the share price higher, and that's why the share price is almost at a 10-year high right now. That's all I have for this technical update, 5th of March 2023 edition, focusing on 11 ASX companies, including Company of the Week, which is Domino's Pizza. I just want to say Domino's Pizzas all the time, but Domino's Pizza. If you have any questions about any companies I featured in today's video, I'd love to hear your thoughts, your opinions, your questions. So leave in the comment section of this video. Otherwise, I'm not a financial advisor If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.